So the topic of this panel is how to generate alpha. And I think it's a very interesting topic because I believe, post-2008, there's been a great dispersion returning on numerous strategies and sectors. For example, biotech, we all know, has outperformed broader markets in the past 2 years. Excuse me, small caps, they've had a great run in 2013. Not had a great year this year. Commodities, they've been underperforming for the longest time. The newest news is oil. It's been down 30% the past month. The U.S. dollar continues to strengthen versus the euro and the Japanese yen. The VIX, very calm, 2013. This year, it's been up and down. October was a great month as far as that's concerned. Simultaneously, stocks, they have not been trading according to fundamentals, but according to the macro economy, and remarks from certain individuals such as Draghi, Bernanke, and Yellen. These factors, in turn, have made it very difficult for hedge managers to obviously generate alpha. So, my question to my panelists, actually, let me take a step back. Why don't we just go down the table here and why don't you guys just introduce yourselves and who you were?
Okay. My name is Mike Tito. I have a multi-strategy hedge fund. I'm a hedge fund manager. I'm an emerging manager. I seeded my fund about 4.5 years ago. I built a track record, and I did a press release a couple of weeks ago, and this is my formal launch. I decided not to do hypothetical returns. I decided to actually build a track record so I could demonstrate as a multi-strategy manager that I understood these strategies and I was a competent manager. I also did a couple things in my launch. I launched a robo-advisor, which is an online financial tool really designed for financial advisors or individuals to be able to go online, put in their financial profile, and then get some actionable advice on how to allocate to alternatives. What I do for them is I look at their portfolio, I say how much should be invested into liquid alternatives, and then within the alternatives bucket, I define for them exactly how much in each strategy and how to use modern portfolio theory as a guide to create a well-structured alternatives portfolio. Obviously, today I'm here to talk to you, mostly institutional and pension community, because I think that this product and my hedge fund strategies program is relevant for an institution as well, looking for very disciplined alternative investment allocations.
And also talking about alpha generation. But we thought you wanted to search for on time here, but Robert, go ahead.
Morning, I'm Robert Maltbie, founder of Millennium Asset Management and Singular Research. At Millennium, we focus on small and micro caps, and we have multi-products. We've got a long-short hedge fund that recently was added to the HFR index. We also advise a mutual fund, a long-short 40-act fund, and we also manage SMA accounts. Our focus is on micro and small cap securities, leveraging our research product. At Singular Research, we incepted about 10 years to take advantage of the cutbacks and the conflicts in research, and we focus on, again, small caps that lack coverage. So our premise and our strategy is to add value and go long securities that are underfollowed, undiscovered, forgotten, and forlorn, and to short the inverse of that.
Okay, thank you. Michael?
My name is Mike Kiley. I am the founder of Kiley Partners, which is an institutional fixed income broker-dealer. We also have a registered investment advisory division in which we manage portfolios in all asset classes. We've been doing this since 1986. Started in Chicago with a couple of regional firms, which have been recently brought out by BMO and RBC Capital Management. I spent a little time with Bear Stearns and Lehman Brothers, learning the trade before I went on my own back in 1995. We advise a $1.2 billion taxable fund, which consists of corporate bonds and municipal bonds, government bonds, a little bit low in the mortgage-backed sector, and a $2.6 billion municipal tax-exempt municipal bond fund.
Okay, great. All right, so as I previously mentioned, we have a lot of stocks not trading according to fundamentals, and they're being driven by the macroeconomic news. Whatever Yellen is saying, whatever Draghi is saying, stocks are reacting to that. So I guess my first question, let me go to you, Michael. Should bottoms up long-term equity managers have some sort of macro overlay within the portfolio or generate alpha?
Yes, I think a bottoms-up portfolio manager, one of the biggest dangers that I see with managers out there, being previously a hedge fund consultant, I saw a lot of managers, and where the problems were that if you have a bottoms-up, a really good analyst at a hedge fund who's breaking out and trying to get on their own, if they don't have an overall macro concept of the portfolio construction, and that may not be necessarily an overlay, but it is a top-down approach on how you're going to structure your portfolio. No matter what you do from the bottom up, you could end up with a real problem down the road. So I absolutely think that you need a top-down structure, a plan for how you're going to invest in alternatives and to generate alpha, because if you can allocate into alternatives, but without those tools of modern portfolio theory or the derivatives more complex variants of it to use with, you're not going to be generating that superior risk return ratio that you like.
Okay, Robert?
Yeah, I agree. I think you really need a macro overlay, and it's really helped us stay out of trouble. We call from about 100 different data series, and we try to get a handle on, we're a long short fund. How much, what should our net exposure be at any particular time? And, it's really kept us out of trouble. Like, for example, in '08, our only down year, we're down 2%. But what was key there is our indicators went very negative and forced us into a position of going neutral to short in the market. So I would find it like a ship on the ocean without a rudder, very difficult to navigate. We may as well just be a long-only fund without a macro overlay.
Okay, well said. Michael Kiley, excuse me. So in order for managers to generate alpha, you think during times of, let's say, 2008, 2011, who knows what's going to happen in 2015, the second half, do you feel that managers should definitely maybe perhaps change their investment process in order to generate alpha, as well as some sort of changes in operations or business processes?
Are you saying that relative to what happened in 08 or 09, that managers should change their...
I'm sorry, Mr. Lux.
Could you repeat the question?
Do you feel that managers should change their investment processes somehow, or maybe change their risk, operations, something along that line in order to generate alpha?
No, I think if you're a good manager, you have to be patient. Great example is if you're a patient investor and 08 comes along and you have a good structure in your portfolio, you're going to lose some money, but you're also going to